Auf Deutsch.
Good afternoon, everybody. Thanks to Matt, Mike, Jim, John, everybody for having us. Great event. Really huge turnout this year, which I think we'll get into a little bit later. But as Mike said, this is the future of ship finance banking. We have an illustrious crowd of, as I think Mike called it, the heavyweights of ship finance here. I'm not supposed to do introductions, so I'll just do them quickly. We have Christos Tsakonas, Global Head of Shipping at DNB. Gaurav Moolwaney, the Regional Head of Transportation at Standard Chartered. Ilias Katsoulis, the Head of Shipping at Deutsche Bank. Tanja, Georg, the Director and Team Head Mobility of KfW. I'm looking down the line here. Vassilios, Maroulis, Global Head of Shipping Citi, and Anna Mao, Managing Director and Head of Origination at CMB Financial Leasing Company. Thank you all for coming. So, as I said, it's a huge turnout, which leads me to question, is anything going on in shipping right now that we're all here instead of working? I guess, the first question, and yesterday one of our alternative lenders said the banks are sitting on the sidelines. So I think I'll start with that question to you, Christos. Are things going on? Is there work to be done? Are the banks sitting on the sideline, or do you respectfully or disrespectfully disagree?
Well, there is certainly a lot of work to be done by the banks. The truth of the matter is that indeed, when it comes to traditional debt financing, vanilla type financing, there is a slowdown. People are uncertain about new technologies. Also, asset prices are very high, and actually I think this is a more critical factor that is holding people back from ordering in big scale. As such, activity for the vanilla type transactions is not as high as we have seen in the past. And whenever there is a good deal, we see increased competition between lenders, and we also see lenders taking bigger tickets. So that's how banks protect their portfolios. But there is a lot of banking work on the non-lending side. We've been extremely active on the M&A side, on the M&A advisory. We advised Frontline on the acquisition of Euronav. We advised Gaslog on the take private, Hög on the take private. The bond market in Norway is opening up again. So there is quite a lot of activity around. Plus, bankers now are making money just sitting still because of the large volume of deposits. So there is something good that comes out of the very profitable market.
Absolutely. Gaurav, but with the banks, with the owners sitting on a large amount of cash, are you seeing repayments kind of reduce returns, or is there other alternative work that's keeping you busy and profitable?
Yeah, so I think to add to what Christos was saying, a little bit to your earlier question, we are seeing a little bit of slowdown in traditional financing, but that is also a function of the fact that a lot of the clients are very, very cash rich, right? It's after many years that we've seen pretty much every sector outperforming, and clients are just not raising the amount of money that they used to. And if they are, they're also looking for lower leverage in a lot of cases, right? So that's also driving a little bit of what the bank market is looking like. And that's sort of factoring into the type of work we're doing. We're looking at the deposits. That's always helpful. But we think that it's going to pick up. It is capital intensive, so we can't run away from it. I think as we get clarity on propulsion, as the order book starts picking up, is where I think that we will see a pickup in bank activity as well.
Ilias, we, as I said, we know everybody's sitting on a lot of cash, right? And I was waiting for someone earlier in the day or yesterday to say it's a paradigm shift, right? Because as soon as someone says it's a paradigm shift, we know it's all over, because nothing changes, right? We've all been doing this long enough to know that it's a cyclical business. So the owners are sitting on a lot of cash, and everybody's talking about how great the markets are. But the markets aren't as good as they were, right? Tradewinds reported a couple of days ago that a couple of VLs, or a handful of VLs, were fixed sub 10,000 a day, and the vast majority of them were fixed below break even. Is that what it's going to take to bring this market back?
Reality is that people have fixed their balance sheets. So I think any short-term blip in the market is not going to make any difference right now, given how long people have made good cash flows. So my view is that the market is going to stay at reasonably good levels at least in the short to medium term. I think in combination with all the cash flow all the kind of nice balances that most companies feature now, I think we're going to have a very healthy situation over the short to medium term.
Tanja, what do you think is going to bring the traditional ship lending market back, or will it come back? And how would you what kind of products or what kind of deals are you seeing? I mean, I'm asking very selfishly because I'm a ship lending lawyer and I need to know when we're going to be busy doing loans again.
Yeah, I think, like everyone said, the demand for ship finance is low at the moment because ship owners are very cash rich. They're reluctant with new orders. The yards are filled. You will only get a delivery date in a couple of years to high contract prices. So, and there's a lot of competition for the loans because they have higher volumes. Other lenders are entering the market. We at KfW IPEX-Bank are still busy because we are also active in niche sectors where we are seeing there's ordering activity. Smaller players, short sea vessels, ferries are old. We see new orders there, and we are also active in the cruise business where there's a lot of work. And I think we all know that shipping is completely cyclical, so the markets will change again, and demand for finance and for loans to be drafted will pick up again.
Vassilios, what's keeping you busy at Citi? Is it the same as Christos with the M&A and more of the investment banking side, or is it the lending as well?
So it's a combination. So we are selectively continuing to pursue, I would say, the traditional ship financing, which are smaller positions, whether it's bilaterals or stuff like that. But at the same point in time, as everyone said, there's a significant margin compression that is taking place. Structurally, people probably are getting also deals which are looser. But at the same point in time, so therefore you have that, you have, of course, the balance sheets which are stronger, you have significant prepayments that are taking place across the portfolio. And that's on the one hand what's going on. On the other hand, what's going on is significant episodic activity. Episodic activity which requires positions which are larger than ever before, which is what is actually taking a lot of our time. And when we're talking about those positions, we're talking about multi-billion-dollar positions in terms of underwriting, backstops that are required, driven, some in M&A and some other in terms of strategic positioning of multiple large players that we bank. And those more than cater for whether it is the reduction or ultimately the reduced activity for the traditional lending, which, as far as Citi is concerned, we're very, very happy for others to do if they want to do it at margins, which I consider to be, hobby-like.
And how is this market affecting the leasing houses as opposed to the banks? Are you seeing a difference? Are you seeing repayments? Are you seeing, exercising of purchase options? What's happening in your market?
I think the market is really slow right now, also for the Chinese lessors. So if we look back at the market, especially the Chinese leasing market, you will see that most of the Chinese lessors maintained a very rapid growth in the past decades. And according to Clarkson, so the Chinese lessors are holding around 9% of the total global tonnages. But we see a clear trend that the Chinese lessors, the Chinese leasing activities slow down a little bit. So right now, we also see a very clear polarizations also in the Chinese leasing market. So while the top tier Chinese lessors, let's say the top 4, can still maintain sustained growth in the market. So like our company, we had a record year in 2022 with a net drawdown amount of 2.2 billion USD for shipping. And we had another record year also for 2023 with a net drawdown amount of 2.4 billion USD. But comparing with the top-tier Chinese lessors, the second-tier ones and the new entrants in this market are facing increasingly fierce competitions. So from my point of view, so the main reason what caused the decrease of the finance volume are as below. So on one hand, as just Tanja mentioned, most of ship owners are right now enjoying a very good life. So everyone has plenty of cash in hand. Secondly, so right now the high asset price and the tight yard slot also restricted the new building orders. There are only a few new building orders and mainly concentrated in some high value added vessel type like gas carriers, PCTCs, etc. So I think the uncertainty also for the future design of a vessel type would be also one of the reasons which caused some hesitations of the ship owners to placing more new building orders.
Let's talk about that a little bit. What is it going to take to get ordering to pick back up? I saw, again, in trade winds, that it looks like there's been some orders, and we saw, the offshore splash and heard a little bit about it yesterday. I think the uncertainty with respect to fuel sources imposed a discipline over a fragmented industry that we haven't really seen before, where folks are hesitant to buy a 20-year asset where they may have to invest a large amount of money to retrofit it in the short term. And in fact, I saw an article a couple days ago where express feeders took a methane-ready vessel straight from the yard to get retrofitted to make it fully dual fuel, methanol and heavy fuel. What is it going to take to get people ordering again, and then to need the cash that this group typically provides?
I think this is the wrong question to be asking. We should not be trying to find ways to incentivize people to order more.
But then what am I going to do?
What we should be, let me complete. What we should be doing, especially in a period where you have technological uncertainty, we should be incentivizing people to prolong the life of existing vessels on the water. We should be incentivizing and financing people to make vessels on the water as efficient, environmentally efficient as possible. This is what we should be doing. At the same time, we should be incentivizing people to experiment with new technologies, to have some sort of certainty about what is the path to follow. We should not be throwing money at people just to order, to generate business for ourselves. This is definitely not the right thing to do. Now, I don't think it's the uncertainty on technology, by the way, which is holding people back. It is the very high prices. Because if you see, I saw people are still ordering containers. This is crazy. You look at the order book, and the last thing you need is more container ship order books. And it's happening. We see people ordering conventional tankers. And what's stopping people is the increase in the prices, not the uncertainty on the technology. But our job should not be to incentivize people to order more. It should be to incentivize people to modernize the existing fleet and make it more environmentally friendly.
That makes sense, and we've heard that from other folks on different panels, over the past few months. But Gaurav, who's going to pay for that? Who should be incentivizing that? Are banks willing to finance that? I know, when we were all talking about scrubbers nonstop, it was a challenge sometimes to find financing for that. Is that the government's job? Whose job is it to create that incentive and to provide that financing?
I think that's the classic challenge, right? Depending on which forum you ask, the ship owners will say probably the charterers, the end users should be paying for it. We should think that maybe the owner should be carrying some of that risk. Banks, yes, should be looking forward, but we also have to understand that banks are providing capital for the finest risk in that capital structure, and we price it accordingly. So you have to distinguish between debt and equity risk. So if there is technology risk, banks should be supporting the right clients, but at a price And beyond that, it has to shift to equity risk. So it will be shared. Governments, owners, charters, and banks, everybody has to collectively come in, and maybe that's also why it's taking a bit longer than usual.
Makes sense. Ilias, who can force it to happen? Is it the end users? Is it the Amazons of the world? Is it the banks? Is it kind of a more stringent Poseidon principles or something like that? Who can force this change that we're talking about?
I think it's not just one party. The reality is it's multiple parties. I will speak on behalf of someone who works for a bank, and I think we have to do our own thing to support the change. We as a bank clearly are as an institution, very sensitive to the impact that ships have to the environment. And we take appropriate action when we assess new lending decisions. And I think every bank has to do the same thing. And I think most banks do it and very actively so. But not everyone is there, I think, looking at the market. So there's still more room for improvement, I think, if we'll self-criticize a bit as bankers.
Tanja, this seemed of interest to you, the environmental impact and the changes based upon our back and forth. What is it that you at KfW are doing to kind of incentivize this?
Yeah, I think you also asked who is going to pay for it and how is it going to happen. It's probably a combination of a lot of people. I just wanted to add that I think it's also that policymakers or governments should also incentivize maybe the step into the decarbonization of shipping. And at our bank, we have to implement our ship financings into our overall ESG strategy. So we already carefully select what types of vessels we finance to bring it to comply with our environmental strategy, and we also look for ways to incentivize and provide access to exactly those kinds of orders. So prioritize efficient ships.
Thank you. Vassilios, I was having a conversation with a friend a few months ago. He said that if we're going to see financings done in this market, it's going to be event-driven. For instance, buying Solstad's fleet. Do you see that as kind of the impetus for maybe more financing activity in the market? Mergers, acquisitions, things of that nature. Do you think that may drive the lending market?
Well, I think that's happening already. It's just that it depends on sort of which company you're looking at and ultimately which space they're in. So, more infra-like, where the sizes are significantly larger and ultimately activity is taking place because there's a lot going on across the board. It's already happening. So it's just that, okay, some of the situations that have been live, if you wish, have not completed yet and therefore not in the public domain. But I think the activity that we are seeing is probably the most significant that we have seen over the past number of years. People are moving. People are finally sort of saying, we have to move, make, sort of decide where we're going and how we're going about it. I think the element of across the board, when I look at it in terms of, where is it that we invest, whether that's on the vessel side technologically or whether that's, companies deciding that they want to go after in M&A situations. I think the paths have been solidified and therefore people know. You know what the technological solutions are for the vessels. You just have to decide now which one you're going to pick. And where are you going? Are you going to go traditional because you have a shorter sort of eyesight and in terms of like, you're looking only 10 years, whether you want methanol, ammonia, LNG dual powered. And then, of course, you have to couple it with, okay, what is your view on EU EAs? What's your view on a potential global carbon tax levy and all of that stuff? So I think The parameters, though, with all the people and all the players that we are discussing are there. They know what they are finally, and therefore on the back of that certainty, you have to be able to be in a position to analyze, which is what's happening, and that's why people are going. So I think there is a very significant activity. It's just that, you know, it's slightly different to how it was in the past. And at the same point in time, I also want to say that, you know, I don't believe that ordering is not taking place. The yards are full, right? I mean, it's across the board, all asset classes. Is that you're seeing an older fleet, and you're also seeing, yes, a lot of companies having significant firepower and therefore not really requiring traditional ship financing to acquire 2, 3, 4, 5, 10 vessels, whatever that is. But in terms of episodic activity and the corresponding additional legs to it, whether that's hedging on the FX side, if you're going to be buying things in a different jurisdiction to your sort of principal currency, all of that stuff is happening and in significant size.
Would anybody else like to chime in on the event-driven?
I agree with what Vassilios said. I mean, you open the news these days, and every other day there's a big transaction being announced, even, you know, yesterday, today, and so on. And I think picking up one of the points around the infra side of things, I think that's a big part of the market. There's a lot of liquidity from infrastructure funds, and I think they're taking over some of the investments in the sector where there are kind of long-term contracts, and those are kind of, generally speaking, kind of quite big transactions. So I think overall, I mean, I'm not worried that lending will not come back. Lending is there, it's happening, and banks are kind of really hungry to provide money right now. So I think it's more about lending wisely, thoughtfully to the right people, and so on, and not kind of creating through kind of our lending activities issues in the industry.
No, there is definitely much more event-driven financing. The difference of this financing is it's very big in size, it's shorter term, it's much more sophisticated, and at least in the early stages, it's not open to all the lenders. In secondary, when in the takeout, yes. So you need a different level of sophistication to be active in this segment, but we do see quite a bit of it, yes.
And the ability to write a big check.
You need to have the ability to write big checks with certainty and predictability and be able to move very, very fast.
Understood. So we all probably saw that HCAB bought NIBC's book, right? So we have one traditional shipping lender that's been through its, you know, ups and downs, increasing the size of its book, and one leaving the market. And we saw that obviously a while back, and anecdotally we've all heard, you know, banks, some of the banks tell me the hardest thing they have to do here is keep money working. And some of the ship owners I talked to in Greece a couple of weeks ago told me, you know, they're keeping a little bit out there, or maybe getting a revolver just to keep the relationships with the banks, but they don't really need the cash right now. Is the only way to grow your book to buy somebody else's book? And also kind of just interested in, who do you think's on the winning side of that trade? You know, is it Cerberus or Blackstone?
Not the only way, but if anyone wants to sell, we're available, by the way. No, I mean, it's a great way to do it, right? Because for obvious reasons. I think they're like not commenting on any specific transaction. I think if you're able to do a large transaction and grow your book, if you have appetite for shipping, if you like shipping, and if you feel that it's an industry you want to be spending your balance sheet on, then doing big deals is obvious. I view.
Anybody else?
But building book for the sake of building book, especially with the new Basel IV environment, does not make a lot of sense. Ship financing is becoming more expensive for lending banks, and yet, you know, as we discussed here in the panel, because there are fewer transactions, margins are getting squeezed. Banks can continue subsidizing this in the short term, but medium term, that's not, it's a recipe which is going to cause banks problems. So unless you have the capability to generate additional income, if you only lend at these rates, if you're buying books of banks at this level of pricing, you will end up with a very unprofitable book in the medium term, which you will not be able to support, and you might be forced to exit the industry because you do not generate returns at par with the other industries, in your institution. So you need to be able to advise on the more sophisticated transactions. You need to be able to charge a premium for your services if you're going to survive under the new Basel IV environment. So I don't think it's the best course of action to be buying portfolios at today's rates.
Tanja, how is... Go ahead.
No, I mean, I think it's somewhere in the middle. I mean, for us, historically, we've always been out there looking at portfolios, and we actually acquired a large chunk of a SocGen portfolio at some point, closed actually here in Marine Money, New York, back in the day. But in terms of, I agree with Christos that we're not there to just grow the book for the sake of growing the book. For all the reasons that I've just mentioned, the book is growing in a healthy way, in organic and actually transactions that we want to pursue, rather than transactions that someone else has originated and through, effectively trying to just, what do? I just need to acquire positions. And of course, in this market where effectively you're not buying at discount, I just can't see why I would effectively be, instead of originating business, trying to acquire someone who has originated other business and try to buy, at whatever price they're selling at. In an appropriate discount, that's a totally different story, at least in my view.
Very well put.
Yeah, and I think to add to that, the sound of using a cliche term, we also have to think of the client angle there, right? So what we would look at is to buy selectively. If you could cherry pick and buy a secondary loan for a client that you might feel that you're underweight on, but just to buy a portfolio with no real client story for the sake of it would make little sense.
I mean, I can maybe also add, we traditionally finance strong corporates. We are a state-owned bank. We focus on supporting European ship owners and suppliers. And I think we are going to stick to that. And we are also faced by the changes through the regulatory changes of Basel IV, for instance. And there might be new structures that we want to look at that help us give good financing offers to our customers further on. But for us, we want to stay disciplined also in a time where there's not so many deals around, and just be very selective on and focus on what our core business is and stick with that.
Tanja, how is Basel IV impacting your ability to deploy capital, or how will it, how is the bank's thought process about putting money out the door changed because of Basel IV?
Well, it's affecting banks differently depending on where they are located. So for the banks in Europe, European banks, the Basel IV regulations will kick in next year, and it will mean higher capital requirements because banks are assessing their risks differently, or have to assess their risks differently, especially in relation to how they assess collateral and security to their loans. So it will affect us. We at KfW, we are trying to look at it to see what kind of structures will still be possible. And I think what I said earlier, focusing on strong corporates with a strong balance sheet and business model is something that we will still be able to do. And we are also looking at maybe adding to the traditional assets as security, adding other forms of security, such as insurances or ECA covers to our financings. So we're at the moment busy dealing with how can we adapt to the changes that are definitely going to affect us. We haven't seen, we would expect to see higher margins because of this. It's not happening up to now, but something that I would expect to see in the future.
Anna, do you see this as an opportunity for the leasing houses? if the bank?
I think yes, as everybody knows that Basel IV are not implemented globally. So right now within China, so the Chinese bank regulatory environment are kind of different. So we are using the Chinese version of kind of Basel III. So the Basel IV right now does not affect us for the time being. So which means we still have certain room to support our core client. But things are changing. So also for Chinese lessors, we keep an eye on how Basel IV is developing and how the European banks right now are acting in this market. So for us, we also change our strategy a little bit. So in the past, you will see that the Chinese lessors had financed a lot of old tonnages or slightly older tonnages. But right now, you see also a very clear trend that the Chinese lessors have spent a lot of money in green energy vessels, like the LNG segment. So with a huge amount investment for the whole LNG segment, so the Chinese lessor is also trying their best to be well prepared for the further further adjustment for the future regulations.
Great, thank you. Christos, we talked a little bit about who should be incentivizing, better technology. How does decarbonization and green, the impact, the environmental impact of shipping, how does it impact your lending decisions? Is it a primary driver? Is it secondary?
It is definitely a primary driver. And, we used to call our analysis credit analysis. And a large part of this credit analysis has to do now with the transition and how companies are positioning for that. What we want to see and what we analyze is that the companies are aware of what is happening. The companies are understanding what's going around them. They understand the various technologies. They're ready to adapt. They're experimenting with new technologies. And, if you're not, as a shipping company, advanced in your thought process, you're not a client for us, unfortunately. So it's at the very, very top of the agenda because we feel that this transition is going to be a very big disruption in the industry. So companies need to be prepared, need to be preparing, and need to be ready for when it comes. Now, when it comes to who is going to fund this, which is the big question, everybody will have to chip in. But I think the lion's share will fall to the final consumer. That's how I think it's going to end up.
Gaurav, and how's that going to change structures? Is every loan going to be sustainability linked? Are there going to be discounts with respect to, or maybe penalties, for poor carbon performance? What are the loans going to look like?
So, how's this going to change? So I think what we've seen is a lot of the assessment here has gone from a good to have in just the last year to a must have, right? So what is going to change is not necessarily 5 basis points plus or minus. I think over time, it's going to start creating a more segregated market. And if you are a company which does not have a transition plan, and we don't expect transition to be overnight, there has to be just transition, the availability of capital will start shrinking as well. So to bury your head in the sand and not have a plan in place is where I think the penalty and incentive will come in rather than just the simple sort of sustainability linked margin adjustments, which we're doing today and which are great structures. But I think the longer-term plan is going to be a more significant shift.
Right, so the money just won't be available if you're not at least moving towards a greener structure.
Transition, not necessarily, but yes.
Ilias?
Just to add on that, I mean, my perspective on Deutsche Bank's perspective is that, I agree with what people have said here, but we want to work with our clients to develop their plans together. It doesn't mean that if you don't have a plan, we don't speak to you. It means that it's obvious you need to have a plan, so let's work together to develop that plan, and we're here to help you out, and that's our job, basically. But for us as well, part of our process now is assessing kind of ESG, and we discuss these things in every panel, but unfortunately it's becoming more and more important every year we're here.
Great, thank you. Well, it looks like we already ran through our time. I'd like to thank all of you for participating. Again, thanks Marine Money, and thank all of you for coming. And I think all you folks have money to lend to good clients out there who apparently are moving towards an environmentally more sustainable product.